guys, welcome back to our econ class. We're going to talk more about the personal finance function of our studies, and we're going to do that by talking about saving for the future. So I also posted in this lesson block a very good short video that explains how savings can build up over time, and it really stresses the importance of beginning to save early. However, it doesn't cover every single thing that you need to know about savings, so we're going to cover this with a PowerPoint in this video presentation. Now, if you guys remember, this smartboard is not working to touch. Even after they were in yesterday, it's still not working. But I'm just going to have to advance this thing on the laptop. So here we go. All right. So growing money. How do we grow money? Well, it all begins with that initial deposit into a bank account. You can take your money home and put it in a mason jar, but it's going to be the same amount of money a year from now as what you're putting in today. The way that you make your money grow is really to collect interest. So let's set some goals. We've set some goals before. And so part of our goals today is we're going to describe the different reasons that you might need to save. We're going to explain how money grows through compounding. And we're going to list and describe the financial institutions where you can save, because it's not always just the bank. Okay? Why you should save is because you'll want to purchase things and you'll want to have expenses that you want to be able to cover in life. And so it is always a wise idea to have your savings ready. The best reason to save money is to provide for your future needs, both the expected and the unexpected. Saving regularly will help you meet your short-term and long-term needs. And let's talk about short-term needs. Now, back when we were talking about financial goals and we were doing the PowerPoint about saving for a four-wheeler, we talked about short-term being something that was less than 3 months. And so there are things that would be beyond your regularly monthly items that you want. So again, your cell phone might be acting up, and you want another one, but you may have to save in order to get that smartphone that you want. Usually you have to pay for these kinds of things out of savings. So you've probably seen your parents where they've had an unexpected expense, where they've had to fix a refrigerator or have some extra work on a car, or maybe they hit a deer and they've got to take some money out of the bank to meet that deductible. Those are the kinds of things that we talk about. That's why you have that savings account. So here we go. Emergencies, like hitting a deer. Vacations, which is always a great thing for us to enjoy. Social events. Some of you will be going to prom. You'll be setting aside some money to come up with a dress or a tux or going out to eat to cover those expenses. Repairs, like I mentioned, if your refrigerator quits, it's hot weather now. We all really like to go to that fridge and get a cold drink, so that's something that we need. And then major purchases, like the smartphone example. Okay, long-term needs are expenses that are costly, require years of planning and saving. So these are usually bigger goals because they take longer to reach. So you may have to save for a few years before you can make a down payment to buy a home. Your parents may be saving for your college education, and you also may be saving for retirement, or your parents may be saving for retirement. And then sometimes people save for a while so that they can begin investing to grow their money in other ways. So what good is financial security? It's just knowing that when needs arise, you'll have the adequate money to pay for those needs. And so financial security is something that we all want. We want to not be stressed about having needs that we cannot meet financially. That adds a lot of stress to your life and to your budget. So how much can you save? It's really going to depend on your discretionary or disposable income. So we've talked about businesses having profit after they cover the cost of making the goods and marketing the goods, okay? Well, discretionary income is kind of like profit. It means that you have to meet your needs, like housing, food, transportation, and you'll have to pay for those things out of your paycheck. And so your discretionary income is what income that does not get directly allocated to the needs of just living. So that's what that discretionary income is. It's a lot like profit that we've talked about before. Also, if you really consider it to be important to save, then you're more likely to save more or set more aside of your income than people who don't think about saving at all, who just live for today. And then if you have anticipated needs and wants, you're more likely to save. So set those goals, because that will be an incentive in your mind to help you save. And then, of course, you have to have willpower not to spend every dime that you receive in your paycheck. Okay. When you take that money and you deposit it into a savings account, that is known as the principal. So it's the principal amount that you save. It's the main source of growing your savings. That's why it's the principal. It's in charge. And it's going to dictate how much your savings grow. Now, the financial institution, you guys are probably still thinking just bank, but you've got several different options. That financial institution is going to pay you because when you put the money in, they're going to use it. They're going to use your money and loan it to someone else, and then that person pays back interest, which is a profit for the bank, after they pay you what they promised. So the bank is paying you a set fee in a percentage for the use of your money, and that's how savings accounts work. The interest is going to be the earning on the principal. So if you put in $100 and the interest rate is 6%, after a year you will have $106. The 100 is the principal, the $6 that you earn is the interest. So as principal and interest grow, more interest accumulates. So the next year, if you left that $106 in, you're going to get paid 6% on $106. So it just continues to get bigger and bigger. How this is noted is compound interest, or interest paid on the original principal plus the accumulated interest. And so that's really how you make that initial deposit grow, is because you're going to compound that interest. Again, if you had put your $100 in quarters in a big water bottle in your room, and it stays in there a year, you didn't pick up an extra $6. But if you place it in a financial institution in an account that pays interest, then you will benefit by the compounding of the interest. Now, how much interest are you going to get? It's going to depend on the institution, and it's especially going to depend on the rate. So APY means annual percentage yield, and it's the actual interest rate an account pays stated on a yearly basis with the compounded included. So in my example earlier, I said you were going to get 6%, which is a really high rate for the current economic situation, but I was saying you were going to get 6%. So 6% would be that actual interest rate that the account pays. Okay. It is law that every financial institution has to calculate this APY the same way. You can use APY to easily compare the yields on different accounts. So if you did decide to go with the bank and you called around in our hometown here, you could compare the rate for Carter Bank, SunTrust, BB&T, okay? If you decided that you're going to look beyond banks, you might include Martinsville DuPont Credit Union in your search, okay? Because a credit union is not a bank, but it is a financial institution, and they do pay interest. And you might find that the credit union is going to pay you more interest. Anyway, so you should always compare the yields. If you got an extra $4 of interest the first year, okay, then that higher rate is going to pay on a larger total for the second year, because remember that interest compounds. So the interest rate is very important. Okay, so in my example, here we are. We started with 100, we got 6%, and that made 106. So you can kind of follow me. The second year, I have 106. See, the ending balance for the first year just comes back to be the beginning balance for the second year. This time, I'm going to pay 6% on $106, who's going to earn more. Remember, this is a decimal here, so 6 times 6 is 36, but since that is on a smaller amount, it goes over here below $1. So 636, and you add this back to this ending balance, and you get 112.36. And the third year, now remember, you haven't put any more money in the bank, but it's growing. The third year, your ending balance of 112 from year 2 is your beginning balance for the third year. Now you're going to multiply this 6% or 0.06 times 112.36, and that gives you 674. So that means you add the 674 to the 112, and your new ending balance at the third year is $119.10. So basically, in 3 years, although the account is only paying 6% interest, you've earned almost $20. $20 on $100 is actually 20%. So see, compounding makes this number grow much faster than if you just had a straight yield. All right. Where to save? Oops, I'm gonna go back one. All right. Again, commercial banks, that would be your BB&T, your SunTrust, your Carter Bank, your, what's that other one? Smith River. Okay. Savings banks, Savings and loan associations, credit unions, brokerage firms, or online accounts. You probably see commercials for ING with the orange line, okay, or Ally Bank. Those are online accounts, and sometimes because they don't have to pay for that building and they have fewer employees, sometimes these online banks can pay more interest than other institutions. Savings and loan associations, we don't have a sign on any of our nearby banks, but if you go down to Winston-Salem, or if you're up in Roanoke, you'll see savings and loan institutions. Credit unions, again, there's only one nearby, and that's DuPont. But in Roanoke, again, there is Valley Star, which used to be the one that the railroad started up there. And then brokerage firm. There's a few brokerage firms in Martinsville. I'm not aware of any of them in our county. But there are lots of choices as to where you can make that savings account. So you want to look and make sure that it's an insured account from Federal Deposit Insurance Company. We'll talk about that. And you want to make sure that if this is your emergency fund, like you don't have a separate emergency fund, then you'll want it to be somewhere local, that if you do have an emergency, that you can access the money. After time goes by and your account has grown, you may want to move part of it to a higher yield account and still keep your emergency fund local. So the goals of this lesson: explain the features and purpose of different saving options, discuss factors that influence the selection of a savings plan, and describe ways to save regularly. You could just start out by every time you spend $10, save $1. Actually, that would be 10% of your income, and that would get you really in the habit of saving without it being too difficult for somebody that's a high school student, because you're really just giving up like one drink out of the machine. Once you have decided to establish a savings program, you need to know about the different saving options available to you. You want to deposit money in several types of accounts because each can contribute to your overall plan in a different way. Okay. Regular savings account is highly liquid, meaning that although the bank is using your money and they are paying you interest, if you need to go over to BB&T tomorrow and get out $100, you can do that. It's very easy to access that money. Now, they sometimes pay lower percentage, but again, you need that emergency fund. So when you get to college, you need an emergency fund. So what is liquidity? It's just how fast you can get your cash without losing any value. Suppose you bought the newest video game system, okay? And you also have a car, and something happens to your car, your parents want you to cover it, you might have to sell that video game system at a loss, okay? If you just had your money over at the local bank, you wouldn't take a loss. All you're really losing is that interest that you could accrue. But again, it is always best to have an emergency fund. A regular savings account is said to be very liquid because you can withdraw your money at any time and they don't charge a penalty. Again, lower interest rate is what you're giving up. Okay. You've ever heard people call about CDs, and sometimes when you go by the banks, they'll have a sign out about what they're paying on their CD or open a CD. You can open a CD, I believe, at $500, which is lower than it used to be. But they did change that because they want to encourage people to save. So a certificate of deposit, or CD, is a time deposit that earns a fixed interest rate for a specified length of time. So you put your money, it's almost like a contract. You put your money into that certificate and you get like a receipt. Okay, if your certificate of deposit is for 2 years, then you'll get the agreed upon yield at the end of 2 years. If you have an emergency and you have to cash in your CD, which is like cashing a check, you take your receipt back, then the Internal Revenue Service is going to apply a penalty to you at tax time. So you've got to pay that money out extra for taking out your CD. And then sometimes the bank or financial institution will also have a small penalty. But you will not get the full amount because it didn't stay in there the full amount of time. Okay, so again, that's just what I told you. It usually requires a minimum, which I believe now is $500. There used to be a time it was $2,000, but now it's much less. If you want the full amount, leave it in the full time. If you take it out early, then you're going to pay. So that full amount of time, you go today and set one up, my maturity date is going to be 2 years from today. If I go next week and set up a CD, then my maturity date would be 2 years plus a week from it, okay? So that date changes, but it just means the day that the contract for the CD has gone its full contracted amount of time, and then you're due that large yield. Okay, what's a money market account? It's probably something you haven't heard about as much. It's a type of savings account that offers more interest rate than a regular savings account. So better interest, you know, sounds really good. What's the catch? So let's talk about it. Okay. All right, so the two different kinds of money market accounts that you can start is a deposit account and the other one is a fund. So a fund might be something that your employer will draw out of your savings each week, you know, as part of your retirement plan. A money market deposit account, you're going to contract to make those deposits on a regular basis. The money market funds will pay a higher interest rate than money market deposit accounts. Okay. Select a savings plan. Liquidity might be what's important to you because it's probably your initial savings account and you'll want to have a little bit of money set aside. Say you bought a car and you've got a little bit of money left over. You'll want to keep some of that money because something may happen to your car and you may have to have a repair or you may have an expense like brakes or tires. Okay? Safety. It's safer than if you're carrying it in your wallet and you drop it, you know. Plus, these accounts are usually guaranteed by the federal government. It's convenient to have a savings plan, and interest earning potential means it'll yield more than if you just kept it at home, but also pay attention to the fees and restrictions on your savings. So this will end savings